for the first version of the VA PSA.
The VA PSA.
PSA, because let's be honest, my buddy Andrew Paul's here. What's up, Andrew?
Hey, man. Great to see you.
Great to have you here.
All of you.
Yes, Navy veteran and veteran advocate. A lot of people follow your Andrew Paul Veteran Advocate page here on Facebook, and here's the thing. And I know our mutual friend on Facebook, David Serpent, was talking about this recently. David is running for governor, by the way. If you would like to have a Marine be the governor in the state of California, you will have an option. David Serpent. So here's the thing, and he talks about this a lot. Veterans get targeted, plain and simple.
Yes.
We get targeted by marketing.
And I hate that word.
Veterans don't like the word targeted. They don't like to be targeted.
Because you know why? Because as veterans, the word target usually means it's something you're doing to an enemy. And so when I hear the word targeted, and when I hear people in the business world talk about, we want to target a veterans group, I'm like, what are you doing? You're coming into, to me, come in to take advantage of. And that's what I hear when I hear people say that they're targeting veterans.
Right. You target stuff that you want to blow up.
Yeah,
kill.
Win, destroy, take from, usurp, I don't know. And look, if you want to help veterans, that's fine. But when I hear people use the word target, to me it stirs up a different kind of a connotation. It drives me crazy.
So that's kind of a little PSA to everybody about not saying the word target veterans. Please don't do it. I mean, if you want to help veterans, like I said, say, hey, I want to help veterans.
Hey, I feel like I have a skill set, I have a service, I have a product, and I believe that this would serve and help veterans. So I want to connect with some veterans who could benefit from what I have to offer. That's how I see what I do for a living in the mortgage business. But when I hear other people who want to, I mean, I just see them as being as wanting to take advantage of veterans. And I mean, you want to get me fired up real fast? Go ahead and talk to me about how you want to target veterans. Man, I will find a way to take you out. Bottom line.
Ryan Street, what's up, man? How you doing, Ryan? Thank you for tackling this topic. Ryan, also a veteran. Thank you for your service as well. Yeah, this is something that veterans really believe in, and so one of the things that's happening with this targeting, Andrew, unfortunately, is there are certain...
Jason, sorry to interrupt you. And with the comments as they come in, I know we can wait. I just saw that and I got fired up. Jason writes,
oh, yeah.
You shoot a target.
You shoot at a target. That's right.
So, when I hear people in the business world who I'm already skeptical of whether their intentions are truly to serve a veteran, and then they use lingo like target a veteran. Thank you, Jason. That's kind of what it is. It comes to my mind is a target is something you shoot. Man, I mean,
perfect way to put it,
I cut you off there, my friend.
No.
Yeah, I'm sorry. I'm just fired up over this topic.
Yeah, I totally get it. Ryan says the predatory practices out there make me sick. They do. If you know what's going on, you know how it's happening, you know why people are doing it for profit, and especially, unfortunately, in the mortgage business. And I think we're going to avoid naming names today.
We will.
Right? We are. We're going to avoid naming names.
Yeah, there's no need to name names.
We don't need to name names. We just want to let veterans know what to look for, what's fair, what's not fair, what you should do to double check yourself, and what you should definitely not sign on the dotted line for.
That's right.
What are some of those things, Andrew?
Well, one of the things, and what I'm trying to do with, I work with a lot of other loan officers and lenders across the country who truly have a heart to serve veterans. And me and a handful of other folks who are very, connected to the veteran community and serve the veteran community, we are looking to align ourselves with other professionals who truly do have a heart to serve veterans. And so I'm part of a couple of different groups that get together and do these kinds of things. And one of the things that I'm trying to bring to the forefront as something that we can all share is this topic of the 1% origination fee. Look, banks need to make money. If they're not making money and they're not profitable, they're not going to be around to continue to serve veterans. So there's a balancing act. There's nothing wrong with being in business and making a profit. If you don't have a profit, you can't be in business, and therefore you can no longer serve people with what you do. But I see, and I know there are people on this feed and who are going to watch this video and who are going to know exactly what I'm talking about. I see lenders in the marketplace who straight up rip off veterans on a daily basis. And they charge not just other fees or higher interest rates, they also charge a 1% origination fee. And most veterans, when they're going to buy a home, they don't have the extra money to pay this 1% origination fee. So I'm seeing a couple of lenders, and look, if you want to Google VA loans, you can probably find some of the top, look at who comes up in the Google search results. And some of these large companies, that's their business practice, is to charge a 1% origination fee. What is that? 1% of the loan amount. So if a veteran's buying a home for $400,000 and say they're getting a loan for $400,000, these companies charge an additional $4,000 flat fee on top of what I find already not a competitive but a much higher rate, an interest rate that's higher than market, in addition to charging an additional $4,000, $5,000, or $6,000 on top of the loan. And most veterans don't know what this 1% origination fee is, and so they don't even kind of understand it until they're already kind of signed on the dotted line and 3/4 of the way through their home buying process. And then all of a sudden they go, wait, I don't have money to pay you an extra $5,000. And then so then there's, oh, well, if you don't, the lender then says, well, if you don't want to pay this 1% origination fee, well, then we can raise the rate even higher. I mean, even higher. I mean, some of these people are just, they are just ripping veterans off. And so the mantra, the marketing, the rallying cry that I'm trying to bring attention to is that if your lender is charging you a 1% origination fee, you need to get a second opinion. That's just the bottom line.
And there's a difference between discount points and origination fee.
That's right.
And we'll get into some details here. We're also going to share some other really cool information that Andrew has access to that will help veterans who are buying homes or refinancing a home. But please share this video. If you want to support the movement, we're really trying to get as many people to be aware of as possible that, and I hate to even use the word, veterans are being targeted by companies, not for a good reason. And what's happening is they're using this huge marketing budget to put a message in front of the veterans, and then they have to pay for that. So
they overcharge the veteran up front, and with all that extra money, they take that money and reinvest it, if you will, into massive marketing efforts that are very successful in drowning out the voices of other companies that want to serve and are there to truly serve veterans. And so they're the biggest, loudest person in the room because they're taking all this money and spending it on marketing dollars. So they're in front of veterans on a daily basis on the web, on the radio, on TV, et cetera. They're paying for it by overcharging veterans on the loans that they're doing. And they've very effectively squeezed out the message from other veterans. So that's the message I'm trying to get across today, Derek.
So if you are buying a home with a VA loan and there is an origination fee that's charged,
a 1% origination
1% origination fee that's charged. This is a practice that's happening. Multiple companies are doing this. They're very big companies. They seem super reputable. Get a second opinion.
That's right.
Get a second opinion on this because it's very unlikely that you are getting the best deal. Let's get a question here. Andrew, will you cover some of the gimmicks that these predatory lenders use to capture veteran business?
Sure, yeah. There's, some of the practices out there are just really in-your-face marketing. They've got massive marketing budgets because they charge so much for veterans. But some of the other things that I see is the charging of points. And so they know that psychologically, like one company that comes to mind that I won't mention, but this is just a business practice that they follow. They know that psychologically, through advertising over and over and over in radio, on TV, and on the internet, et cetera, over the years, the consumer, whether that be a veteran or non-veteran or whatever, has been conditioned to just only think that all that matters is the rate. And so they just think rate. And a first-time buyer especially doesn't know what else to ask, what other nuances or complexities are involved in buying a home or getting qualified and actually approved for your mortgage. And so they just think, well, I guess the only thing I need to know about is what's the interest rate. And so knowing that, these companies play a game where they just post the lowest possible interest rate on their website. And so the unsuspecting consumer or veteran sees this low number and thinks, oh, well, they seem the lowest, I should just go with them. And then in the fine print, it discusses the fact that above interest rate, for example, requires the payment of a 1% origination fee, and in addition, perhaps, the paying of another 1 to 2 discount points. So discount points is another thing that a bank will charge. It's money up front that the bank charges to lower your interest rate over the life of the loan. Now listen, this term discount points is very confusing because it's a term that's used in the lending business. Now I don't know about you, But when I hear that Walmart is having a discount or a blue light special going on, I'm thinking I'm getting money off, right? And the consumer doesn't know that a discount point is in fact additional fees that you pay, not something that you get off, right? They pay more to discount the interest rate. So a discount point is additional points or fees that you pay up front so that a lender will give you a lower interest rate. But again, just not knowing any of that, just going to the website and seeing a low interest rate posted, most likely not reading the fine print to ultimately discover that you're paying 1 point origination and 2 points discount, or a total of 3 total points, which on a $500,000 loan would be $15,000.
Jeez.
Yeah, that interest rate looks really good. By the way, if you want to pay our company $15,000 up front, yeah, we'll give you a 3.5% interest rate too, for example. But the consumer doesn't understand that that low rate comes with these extra points attached to them, and they don't even know what they are. They just skim right over. Oh, they got a discount going on. No, it's not a discount. These are extra points that you pay. So Ryan, that's one of the practices that I feel is misleading. To me, it takes advantage of a nuance in the language, the word discount, that most consumers don't understand. That in fact it's not money off; it's an additional fee. So I don't know. Maybe there's other ones that you'd like me to speak to, Ryan, or anybody else. But that's something I see.
Yeah, there's definitely a number of them, especially with the language and the look and feel, and a lot of the branding and stuff that goes on, and a lot of the what you would call like cause marketing that's done. So there's a number of different practices like that. But
right.
the fact is this: if you're a veteran buying a home and they're charging you 1% origination fee, you need a second opinion, and you need it quick, because you're going to end up overpaying if you get locked into that deal. And most likely too, and this is what we've noticed, most likely as well, if it's the case that you're being charged that, you're probably paying a higher interest rate than market as well.
That's what we've seen. Now, there's nothing wrong. Look, as long as you understand what you're getting, and what you may be getting there is that as long as you understand that if you're willing to pay points up front, more money up front, then you can get this lower interest rate. But a lot of times, these lenders are charging, the rate itself may be the same as kind of the market or whatever everybody else is charging, but they're also charging this 1 point, and that to me is, it's just overcharging.
Yeah, it's gouging.
Yeah.
I mean, that's you're whacking people. You're whacking veterans with origination points.
So if you're watching this video and you know a veteran who's in the market and is thinking about buying a home, they don't have any idea about what points are, right? I mean, there's so many moving parts to buying a home and getting a pre-approved and things like that. They don't know any. Share this video, okay? This is why we're calling this the VA PSA, right? The VA loan public service announcement. Just share this so that we can start making sure that this word is getting out and that veterans and all consumers for that matter are making an informed decision with all of the information that's available to them.
Let's get to a quick question here in the comment thread, and feel free to say hi, say what's up. We are live here on Facebook, and of course please share this video so we can get the word out. John says, a question, why do you feel it's more difficult to get a VA offer accepted versus conventional?
Great question, John. To me, it is because there is bad information in the marketplace. There are real estate agents out there who have a misunderstanding of what the requirements are of the VA loan. They think, for example, that as a listing agent or as a seller, that if they accept a VA offer, that they are required to pay additional fees. They think that the VA requires the seller to pay things on behalf of the veteran, and that is simply not true. The VA does have what is considered non-allowable fees, that is, fees that the veteran's not allowed to pay. But if the lender does not charge a 1% origination fee, like for example we don't, then the veteran is allowed to pay their own closing costs. And but that concept has been bastardized, has been misinterpreted, has been shoved down the throats of sellers and listing agents by perhaps buyer's agents who are trying to bully or negotiate or try and get that seller to pay. And ultimately, that's one of John, one of the things that I see is that there is this misconception that if I accept a VA offer, it's going to cost me or cost my seller more money. That is simply not true. Okay, so that's one of them. There are others. I mean, I do a VA seminar every month for real estate agents to specifically dispel these myths and misconceptions. That's one that comes up a lot that we discuss. And there's many others I'm happy to speak to, but
yeah,
that's one.
Yeah, I think we can send you some more information, John, directly about this. There's a lot of different misconceptions out there about the VA loan, and Andrew has videos. If you want to search on YouTube, you can find those as well. Another question from Ryan here: do DTI ratio caps vary from lender to lender?
Great question. So DTI ratio caps. So first, let me explain what that is. Again, that's an industry lingo word. DTI is debt to income ratio. So oftentimes somebody will say, well, hey, Andrew, how much do I qualify for? How much you qualify for comes down to this DTI, this debt to income ratio. And that is a ratio of your total monthly expenses, so principal, interest, taxes, insurance, so your mortgage payment, plus your car payment, credit card payments, any other obligations. So total monthly expenses divided by your gross monthly income. So if your total monthly expenses for your mortgage and your car payment and everything was $3,000 a month, and you make $10,000 a month, for example, that would be a 30% debt to income ratio. 3,000 divided by 10,000, okay? Now, different loan programs have different caps in terms of how high you can go on that debt to income ratio. And that's ultimately what determines how much a person qualifies for. So the more debt you have, the less home purchase price you're going to qualify for. And now Ryan's specific question was, do DTI caps vary from lender to lender? And the answer is yes. And different lenders have different policies and different overlays and things like that. And for us, I mean, it also varies obviously from buyer to buyer. One buyer's situation is completely different from somebody else's. So a buyer who has a ton of money saved up in the bank, in other words, lots of reserves in case of something breaks or a rainy day, they're in a more stable financial position. We are therefore allowed to push that debt to income ratio higher. If they've got sterling credit history, haven't missed any payments in the last year or 2 years, and great payment histories, and their credit cards aren't all maxed out, that will also allow us to approve them with a higher debt to income ratio. So even at the same bank, where you may have two different borrowers making the same money, the same amount of same pay, if they have different, even if they had the same monthly expenses, if their credit histories are different, and one person has more money saved up in the bank than this person, there's a chance this person will be able to be approved for higher because we can push the debt to income ratio. But to answer your question directly, Ryan, now that you've explained that context, yes, some lenders have lower thresholds on the debt to income ratio than others do.
All right, great question. And keep them coming. If you guys want to ask Andrew questions, keep them coming. Share this video. Let's get this VA PSA out there. Reminder that the purpose that we're trying to get across here is that if you're a veteran, you're using a VA loan to buy a home, and you're being charged a 1% origination fee, say no to the 1% origination fee. Get a second opinion.
Get a second opinion.
Do not sign on that dotted line. Do not sign those disclosures with a 1% origination fee. You're probably being overcharged. Your interest rate is probably too high as well. That's what we have found. It's not right, but it's happening all day, every day, right now. Someone's probably signing docs right now. A couple things while I have you here, Andrew.
Yeah.
Because a couple other myths like credit, co-signing, VA loans. How does that? Can someone co-sign for VA loan that's not a veteran? How does that work?
Yeah. So, well, the VA loan is traditionally meant to be for a veteran to buy their primary residence. Okay. So who can go on a VA loan? A veteran with their spouse. So spouse can co-sign. A veteran and another veteran. But actually, the VA does even have a provision to allow a non-veteran to co-sign on the VA loan. Now, when we do that, it's very nuanced as to why, et cetera, but you just have to know that if a non-veteran wants to co-sign on a VA loan, you will have to put a 12.5% down payment down. It's what the VA calls a joint loan. It requires the VA's prior approval. In other words, like, not only do we underwrite it as a lender, but then it has to then go to the VA, and the VA has to sign off on it as well. If that non-veteran who is co-signing for that loan actually does not have to even live in the home, the only requirement is that whoever is using VA loan entitlement, i.e. a veteran, is the only person who has to certify that the home will be their primary residence. So a non-veteran can co-sign on a VA loan. It's called a joint loan. Practically speaking, though, the challenge is it requires a 12.5% down payment at a minimum. So that usually kind of knocks people out. So because a lot of times what happens, Derek, is I've got a veteran who, the main benefit of the VA loan is that you can go 100% financing. So a guy goes, hey, I want to buy this $500,000 house. I don't have any money, so I want to go 100% financing. You're like, cool, yeah, that's the deal with the VA loan. They go, actually, now that we look at your income and your debts, you don't qualify for that $500,000 house. And he goes, well, hey, but my dad's willing to co-sign with me. Can we do that? Yeah, your dad can co-sign on the VA loan with you as a non-veteran, but now we lose that 100% financing deal. So now we got to do 12.5% down. And at that point, if you have enough money to put 12.5% down, it might be worth looking at a conventional loan, maybe. We got to look at different things side by side. The VA funding fee, conventional loan is going to have monthly mortgage insurance. A VA does not. What's your credit scores? Conventional loans are very sensitive to what the credit scores are. So if you have some credit blemishes, that's going to jack the rate up higher on a conventional loan, whereas a VA loan is more tolerant of credit blemishes. So
let's talk about
it becomes more complicated.
Let's talk about those credit events. I think that's something that holds back a lot of veterans from being able to take advantage of the VA loan opportunity. They feel like, hey, I had a credit event, whether it was a bankruptcy or maybe there was a foreclosure or a repossession or something like that. So how do those credit events work with eligibility?
Yeah, great. VA is, again, very tolerant. Some people think that, hey, I've had a bankruptcy or I've had a foreclosure. The waiting period on a VA loan is 2 years. So after 2 years, you can buy again. The other thing is that some folks say, well, I had a foreclosure. If FHA and conventional have longer waiting periods, whereas VA, again, only 2 years. And then other times people will say, well, I had a foreclosure 10 years ago, and that foreclosure was on a VA loan, so I can't use my VA loan anymore. That's also not true. What actually happens in that case is that whatever entitlement or insurance that you had from the VA that was used to insure that loan that went to foreclosure, that entitlement is gone. You do not have to repay the VA. It's not a debt. The VA doesn't come after you. You don't have to pay it back. And whatever remaining entitlement you have can be used on another VA loan. So if you've had a bankruptcy, if you had a foreclosure, the waiting period is 2 years on a VA. And if that foreclosure was on a VA loan, you still may have remaining VA entitlement that you could still get another VA loan, most likely. And those are the details and the nuances that somebody who truly is a VA loan expert and a specialist can dig into and find out from you. And I'll just tell you this too, Derek. There's a lot of people out there advertising and say, I'm a VA loan expert, I'm a VA loan specialist, but I will just tell you, most all lenders can do a VA loan, but I'll tell you the statistics are that for most lenders, 1 in 10 loans that they do is a VA loan. Now, imagine you're going to go in and get LASIK surgery. You want to go to the guy that says, yeah, I did one of those last year, or I did 3 last year. No, I want to go to the guy that just did 10 today. That's the guy who I want working on my eyeballs. And it's the same kind of a thing, right? For me and for my company, 90% of what we do is 90% is VA loans. So, if you're working with a veteran or you are a veteran, please go to somebody who truly is an expert and a specialist, not just somebody who puts it on their business card, but somebody who truly is dealing with and doing VA loans day in and day out. And so that's my piece on that.
We'll get some more questions here. John says the VA FHA amendatory clause, if a buyer agrees to remove his appraisal contingency up front, but the VA FHA clause has been signed by all parties, what would stand up if the home doesn't appraise and the veteran doesn't have the money to come in with to make up the difference? So this situation, I'll just kind of paraphrase this. So we've got a situation where they've signed off on the appraisal contingency, but the appraisal comes in low. Mm-hmm. So our purchase price is, let's say, $500,000. The appraisal comes in at $480,000.
Yeah.
But we've waived the appraisal contingency, and the VA FHA clause has been signed by everybody. What would happen then? What holds up?
Well, I think there's couple things to consider here, John. The first question is really a matter of contract law, and I can't really comment on that unless what would win out. I mean, you have a potential problem of just, okay, wait, you signed a contract that was not contingent on an appraisal, but you have another provision in the contract, specifically the VA mandatory clause, that states that the veteran is not obligated to proceed if it appraises for less than the value and is not subject to forfeiture of earnest money. So what language wins out? Some arbitrator would have to make that decision. I don't know contractually. You have 2 competing clauses essentially in this contract, given the scenario that you've described here, John. So I don't know the answer to that. I'm not an attorney, so it's not really appropriate for me to say what would win. But what I can speak to is that in order for the loan to be eligible for VA financing, the VA mandatory clause language would have to be acknowledged as sort of superior. If without the VA mandatory clause language being in effect in the contract, the loan is not eligible for VA financing. So I don't know what would happen contractually, but I can tell you that the VA may look and say, hey, you got a contract. I mean, what the law says, and this comes from Code of 38 Code of Federal Regulations, like this 4313 kilo. It says, and I know that because I give this in this VA seminar that I teach like every month, and it's right in the Code of Federal Regulations, and it says, in short, that no loan will be eligible for guarantee by the Veterans Administration that is not written to include or to subsequently be amended to include the following language. And that is verbatim what the language says, and then it puts in that VA mandatory clause language. So it is not eligible for insuring by the Veterans Administration if that language is not, what's the word I'm looking for, like in effect, in the contract. So I don't know,
it's
John.
not respected. It needs to be respected. That language needs to be respected. Good question, John. Really, really specific questions here. We got some more from Ryan. Can you cover the definition of a par interest rate, optional rate increases for lender credit, how they can be applied to closing costs, how temporary rate increase at the time of purchase can benefit the veteran, and the nuances of the VA IRRRL product?
Got a lot of questions in there, Ryan Street, but
Yes.
I appreciate you teeing me up there to just hit
interest
those
rate
things.
questions, big time.
So, all right, here's the deal with interest rates. What Ryan referred to and what we call the par interest rate. That is an interest rate that a lender is willing to offer you where they are not charging you any points, okay? I'm going to just make up numbers. These are not offered rates right now or anything. Let's just kind of pick a round number and say, for example, that the rate today is 4%, no points. Bear with me. That's what we call the par rate. Now, you have a choice in your interest rate. You can go down, lower, or you can go up, higher. Par at 4%, no points. Now you can pay additional points. I mentioned that earlier. That is, you pay the lender upfront points or additional money. So the bank says, hey, pay us today. We'll give you a lower interest rate. Therefore, we as a bank will make less money over time because we are earning a lower rate on the money we've loaned out. But we're willing to do that if you pay us today. That's called paying points, or paying points upfront to buy down the interest rate. Also what is referred to as discount points. Again, a confusing term. Points that you are paying to discount the interest rate. It's not money off, okay? So that's paying points to buy down the rate, lower than the par rate. And then in addition to that, you can go up in interest rate. So above par, so from 4 to say 4.5. Well, now the bank says, well, look, if you're willing, nobody's going to hold a gun to your head and force you to do this. If you're willing to take a 4.5% interest rate, well, then over time, we're going to make more money on the loan because we're earning a higher interest rate on the money. And in exchange for that, we'll give you money up front. Now, not money to put into your pocket and take home with you, but we'll give you a credit up front. Maybe it's $4,000, maybe it's $8,000, and you can use that money to pay your closing costs. So the bottom line takeaway here is that on any given day, you have a choice in your interest rate. Par rate, no points, paying additional points up front to buy down the interest rate, or voluntarily taking a higher interest rate in exchange for a lender credit to help pay for some or all of your closing costs.
So if you're buying a home with the VA loan, can you, if you take a higher interest rate in order to pay for closing costs, can you get into a home with no money out of pocket?
Absolutely.
So you don't have to pay, I mean, you can get everything covered, basically.
Absolutely, yep.
That's incredible, because I don't think other products allow for that.
No,
right?
you do. You can. I mean, the closing costs can be covered on any loan program, and that mechanism of the interest rate is true for all banks and all loan products.
Really?
Okay. Yeah.
So that's a universal thing across.
Yeah, that's just kind of how banks and interest rates work. Now, I don't have time to get into the details on this right now. Real estate agents oftentimes don't want to negotiate to get a seller credit to pay for the closing costs because many times an agent will tell you, hey, in a competitive market, it's harder to get a seller to do that. And so they'd rather say, hey, just talk to your lender, take a higher interest rate, and get the closing costs paid for that way. There are some challenges with that, and I don't have the table here to show you this, but usually when I meet with my clients one-on-one, I show them the difference. Then let's say you needed to get $10,000. Let's say you were going to buy this house for $400,000. Well, sellers are net price focused, so if you want to get a $10,000 credit from the seller, you probably need to offer to pay them $410,000 for the home. That way, they'd be willing to give you $10,000 credit for closing costs. That way, they're still netting and walking away with $400,000. Now, so if you do that way, it changes your payments by, for example, maybe $65 a month. But if you wanted to get the same $10,000 from us as a lender, we have to raise your interest rate by, say, maybe 0.5%, and then that's going to change. Now you buy the house for $400,000, but you get a 0.5% higher interest rate. That changes your payment by maybe $95 a month, and over the life of the loan, you're going to pay a lot more in interest. So, look, there's nuances to the market, into negotiating and getting your offer accepted and things like that. The best way to handle closing costs is to just pay them yourself. But if you don't have the money to pay your own closing costs, the next two methods are to, one, negotiate with the seller to give you a credit, or two, voluntarily take a higher interest rate from a lender in exchange for credit. And in the long run, the latter, that is taking a higher interest rate, will cost you a lot more in the long run. So those are my 2 cents on that.
Getting a buzz by here.
Yeah,
boys
man.
at Miramar are getting fired up there.
Buzz in the tower.
They buzzed us.
Oh no, man, it doesn't look good. It doesn't look good.
You don't. Pretty much anywhere
I dare
else,
you to spill your coffee. God damn that guy.
Anywhere else in the world, you do not want to hear that sound because it's too late.
I kind of like this sound. That means I'm coming right overhead and crushing those guys over there that I'm calling for fire on. But
Another question that he has in there, and I also have a question too, but the Earl product. So this is also unique. If you have a VA loan right now on a home, and let's say your rate is higher than what the market rate is, the ability for you to essentially swap into a lower rate is really easy with the VA loan.
Yeah, one of the unique features and benefits to the VA loan is that you have this option of what's called the VA Earl, the Interest Rate Reduction Refinance Loan, IRRRL. Okay, Interest Rate Reduction Refinance Loan. Everybody just calls it the Earl. So what that does is essentially you get to lower your interest rate. There's no requalifying, no appraisal. We just lower your rate. We can close those loans in like 12 days. Super easy. We do have to make sure that you have made 6 payments on time. That's now a requirement. And so we do pull your credit just to make sure that you've made 6 payments on time, and that you also haven't been delinquent in the last 12 months. But just on the mortgage, we don't look at anything else on the credit. So we pull a mortgage-only credit report just to look at the payment history on that mortgage and make sure that you're current and that kind of thing. But then we just lower your interest rate, no appraisal, no requalifying, nothing.
What a sweet deal.
It's a great deal.
What a sweet deal. Because things can change. Like a lot of times, one of the things that's, if you don't have a VA loan, people need to refinance because they want to save money. They can't qualify because they don't make enough money, but they need to save money.
Yeah, I know.
And so it's that's one of the things.
It's just that the new lender doesn't want to take that guy on. He's like, you can stick with your
exactly. So
you that no longer have your job, we're glad your loan's with that guy, and so you don't qualify because we don't want to take you on because you don't have income now, right? Or whatever, right? That's whereas with a VA Earl, it's not required.
Yeah, not required to just take the deals, which is really awesome. So I have one more question for you.
Yeah.
Multifamily. This is something that a lot of people have been asking about lately.
We're getting the wrap it up sign.
Are we getting the wrap it up sign? Is it wrap it up time?
Okay. I'm having fun
though. Is it 45?
It's past that.
Is it really?
Oh, time flies when you're having fun.
Is it 50?
50.
Okay.
All right, we're gonna have to wrap soon. You're asking me about multifamily. I'll hit this really quickly. Really great opportunity. I mean, if I was 22 years old again and still active duty, I would team up with a veteran buddy or buddies, and I would buy a 2, 3, or 4 unit property because those are all buyable with a VA loan. You can use a VA loan to buy a 2, 3, 4 unit, up to 4 units. So you buy a 4 unit property, 2, 3 buddies, all using your VA loan, teaming up together. That might be a $1 million property here in San Diego. But if you got 3 guys going in on it, it's basically like you're all qualifying for a $300,000 loan, right? Each of you $300. It's one loan, but think of it like that. You buy a 4 unit property with 3 buddies. Maybe you're 3 single dudes like for me in the SEAL teams, 3 single dudes in the SEAL teams, we're gone all the time, we're never around. We buy a 4-unit, a 4-plex, right? We cram into 1 unit because we're never there half the time. That's our primary residence now, that 1 unit we're all sharing. Rent out the other 3, pays for the whole mortgage, slam dunk, set for life. I'm just telling you, if you are single dude, put 2, 3 guys together, go buy a multi-unit property, it will be the best investment you ever make in your entire life. You will crush it all day long. Do it. Do it.
Just
I
do it.
Like, I literally cannot even tell you, it is by far the best. If you are 3 single dudes, 3 junior officers, 3 6s, I don't care, go buy a 3 or 4 unit, combine, team up, buy this thing together. You'll never make a mortgage payment because the other 3 units will pay the whole dang thing, and you will be set for life. I promise you.
Will you Shia LaBeouf it for us?
I don't even know what that means.
Just do it.